Ray Dalio spent 20 years building the most successful China strategy on Wall Street. He defended Chinese markets when everyone else called them risky. He invested $40 billion when others pulled out. He became Beijing's favorite American billionaire. Then, in late 2023, something changed. Without warning, without explanation, Ray Dalio began quietly liquidating Bridgewater's entire Chinese portfolio. $40 billion. Gone. Pulled out so carefully that Beijing didn't notice until it was too late. What did Ray discover that forced him to abandon his life's work on China? What secret intelligence changed the mind of the man who once said China is uninvestable only to become its biggest advocate? And why is he now warning that investing in China could destroy your entire portfolio by 2026? The answer takes us back to 1984, when a young Ray Dalio made his first trip to China. What he saw there would shape his investment philosophy for the next 4 decades. And what he saw in 2023 would shatter it completely. But first, you need to understand just how deep Ray's China obsession went. Because without understanding his love affair with Chinese markets, you can't comprehend the magnitude of his betrayal. It was October 1984. Ray Dalio, then 35 years old and running a small hedge fund out of his apartment, stepped off a plane in Beijing. China had just begun opening its economy to foreign investment. Most Wall Street firms considered it too risky, too unpredictable, too foreign. Ray saw something different. He saw the largest economic transformation in human history happening in real time. For 2 weeks, Ray traveled across China, meeting government officials, studying economic data, and observing what he called the greatest wealth creation machine ever built. He returned to Connecticut with a radical thesis: China would become the world's largest economy within 30 years. In 1984, China's GDP was $300 billion. The United States was $4 trillion. Ray's prediction seemed insane. He was right. But Ray's China thesis wasn't just about economics. It was personal. During that first trip, Ray had experienced something he'd never felt in American markets: the excitement of being part of something bigger than profit. China was lifting 800 million people out of poverty. They were building cities overnight, creating universities, transforming human civilization. I felt like I was witnessing the future, Ray would later write, and I wanted Bridgewater to be part of building it. For the next 2 decades, Ray became China's most passionate advocate on Wall Street. When Asian markets crashed in 1997, Ray doubled down on China. When dot-com bubble burst in 2000, Ray moved money to Shanghai. When the 2008 financial crisis devastated global markets, Ray increased Bridgewater's China allocation to 25% of total assets. Every time the world turned away from China, Ray leaned in deeper. His bet paid off spectacularly. From 1984 to 2020, Bridgewater's China investments generated returns that averaged 23% annually. $1 million invested in Ray's China strategy in 1984 would be worth $180 million by 2020. Ray didn't just make money from China. He became China's unofficial ambassador to American finance. He gave speeches defending Chinese economic policy. He wrote research papers praising Chinese innovation. He brought American executives to Beijing and arranged meetings with Communist Party leaders. By 2020, Ray Dalio was more trusted in Beijing than most Chinese economists, which makes what happened next so shocking. The first crack in Ray's China thesis appeared in March 2022 during Russia's invasion of Ukraine. While the world watched tanks roll toward Kyiv, Ray was watching something else: Beijing's reaction. China didn't condemn Russia. They didn't join sanctions. Instead, they quietly increased trade with Moscow and began what Ray's team identified as strategic economic cooperation with Putin's regime. For Ray, this was troubling, but not devastating. Geopolitics was complex. China had its own interests. Ray had seen Chinese leaders make pragmatic decisions before. But then came the real shock. In August 2022, Nancy Pelosi visited Taiwan. China's response wasn't just angry rhetoric, it was a complete military encirclement of Taiwan that lasted 72 hours. Ray watched the crisis from Bridgewater's Connecticut headquarters, surrounded by screens showing Chinese military positions, Taiwanese stock prices, and global shipping routes. For the first time in 40 years, Ray began to question whether he really understood China. Something had changed. Ray would later confide to his executive team. The pragmatic, growth-focused leadership I'd worked with for decades was being replaced by something more ideological, more unpredictable. But Ray's real awakening came 6 months later in a private meeting that would change everything. In February 2023, Ray received an unusual invitation. A Chinese official he'd worked with for 15 years wanted to meet privately in Singapore. No staff, no records, no official agenda, just two old friends discussing the future. The meeting lasted 3 hours. What Ray heard in that Singapore hotel room shattered his 4-decade China thesis. Ray, his Chinese counterpart, said, "You need to understand something. The China you invested in, the China you believed in, that China is gone. What's coming next is something different, something you won't recognize." The official explained that President Xi Jinping's vision for China was fundamentally different from his predecessors. Where previous leaders had prioritized economic growth and international integration, Xi prioritized national security and ideological purity. The old leaders asked, "How can we get rich?" The official continued. The new leadership asked, "How can we get strong?" Those are very different questions with very different answers. Ray left Singapore deeply shaken. For the first time since 1984, he began to question whether foreign investors had a future in Chinese markets. But the real bombshell came 2 weeks later. Ray's research team had been tracking unusual patterns in Chinese capital flows since late 2022. Money was moving out of China faster than official statistics indicated. Not retail investors or foreign funds, but Chinese institutions themselves. Chinese state-owned enterprises were quietly moving assets to Hong Kong, Singapore, and London. Chinese billionaires were accelerating their overseas investments. Even Chinese sovereign wealth funds were reducing their domestic allocations. If Chinese institutions are moving money out of China, Ray asked his team, why are we moving money in? The question haunted Ray for months. He commissioned what would become known as Project Dragon, Bridgewater's most comprehensive analysis of Chinese political and economic trends ever undertaken. Project Dragon's findings were devastating to everything Ray believed about China. The research team discovered that China's economic model was fundamentally unsustainable. The debt levels that had fueled growth for 3 decades were now threatening the entire system. Local governments owed $12 trillion they couldn't repay. Property developers had liabilities exceeding the GDP of Germany. Banks were hiding losses that could trigger a systemic collapse. But the economic problems weren't the worst part. The worst part was what China planned to do about them. According to Project Dragon's analysis, Beijing was preparing for what they called the Great Decoupling, a systematic reduction of economic ties with Western nations. Not because of Western pressure, but because Chinese leaders had decided that economic interdependence made China vulnerable. The implications were staggering. China wasn't just risking a trade war with the United States. They were preparing for an economic Cold War that could last decades. Ray realized that his entire China strategy was built on a false assumption. He'd assumed that China's leaders were rational economic actors who would always prioritize growth over ideology. Project Dragon revealed that China's leaders were rational, strategic actors who were willing to sacrifice growth for security. I had been playing chess while they were playing war, Ray later reflected. And in war, economic logic doesn't apply. But Ray's decision to withdraw from China wasn't triggered by Project Dragon's findings. It was triggered by something more personal and immediate. In July 2023, Beijing announced new regulations restricting foreign access to Chinese economic data. Companies like Bridgewater would no longer be able to access the information they needed to make informed investment decisions. For Ray, this was the final straw. How could you invest in markets you couldn't analyze? How could you manage risk in systems you couldn't understand? They were asking us to invest blindly, Ray told his investment committee. After 40 years of partnership, they were asking us to trust them completely while telling us nothing. That's not investment. That's faith. And faith doesn't belong in portfolio management. Ray's withdrawal from China was a masterpiece of financial engineering. Over 6 months, Bridgewater systematically reduced their Chinese exposure without triggering market panic or government attention. They used derivatives to hedge positions before selling them. They liquidated holdings through multiple brokers in different cities. They converted Chinese assets to Hong Kong assets, then Hong Kong assets to Singapore assets, then Singapore assets to American assets. By December 2023, Bridgewater's China allocation had dropped from 25% to less than 2%. $40 billion had been moved so quietly that Chinese regulators didn't notice until Ray announced it publicly in January 2024. Beijing's reaction was swift and angry. Chinese media accused Ray of economic betrayal. Government officials canceled meetings and froze Bridgewater's remaining Chinese operations. Ray received death threats from Chinese nationalists who saw his withdrawal as an attack on their country. Ray was unmoved. I spent 40 years building relationships in China, he said in a private interview. I didn't throw that away lightly, but when you see the ship sinking, you don't debate with the captain. You get in the lifeboats. But Ray's China withdrawal wasn't just about protecting Bridgewater's assets. It was about warning other investors before it was too late. In March 2024, Ray published what many consider the most important investment memo of his career, The China Reckoning: Why the World's Second Largest Economy is Uninvestable. The 62-page document laid out Ray's case for why China was entering a period of economic and political instability that would make foreign investment impossible for the foreseeable future. Ray's analysis focused on 3 critical factors that most investors were ignoring. First, China's demographic collapse. Ray's team calculated that China's working-age population would shrink by 200 million people over the next 2 decades. No economy in history had maintained growth while losing a quarter of its workforce. Second, China's debt crisis. Local governments, property developers, and state-owned enterprises owed a combined $50 trillion, more than 3 times China's GDP. The debt was growing faster than the economy, making default inevitable. Third, and most importantly, China's strategic pivot away from economic integration. Beijing was systematically reducing dependence on foreign technology, foreign capital, and foreign markets. They were choosing security over prosperity, ideology over pragmatism. China is becoming North Korea with better infrastructure, Ray concluded. And North Korea, despite its nuclear weapons, is not a good investment. Ray's memo triggered a global debate about China's investment prospects. Some analysts accused him of overreacting to short-term political tensions. Others praised his courage for speaking truth that most investors didn't want to hear. But Ray wasn't interested in debate. He was interested in results. And the results were already proving him right. By summer 2024, other major investors began following Ray's lead. Warren Buffett reduced Berkshire Hathaway's Chinese holdings by 70%. The California Public Employees Retirement System divested from Chinese military companies. European pension funds began excluding Chinese investments from their portfolios. The exodus accelerated when Donald Trump won the 2024 election and appointed China hawks to key economic positions. By January 2025, foreign investment in Chinese markets had dropped to levels not seen since the 1990s. But Ray's most prescient warning concerned what he called the Taiwan trigger. In his March 2024 memo, Ray had predicted that China would attempt to assert control over Taiwan before the end of the decade, not through invasion, but through economic pressure and military intimidation designed to force Taiwanese submission. Taiwan is not just a strategic asset for China. Ray wrote, it's a psychological necessity. Chinese leaders believe they cannot be considered legitimate until Taiwan is under Beijing's control. Ray's analysis suggested that any Chinese move against Taiwan would trigger automatic sanctions that would cut China off from global financial markets. Chinese assets would become instantly worthless to foreign investors. When China moves on Taiwan, Ray predicted, every dollar invested in Chinese markets will disappear overnight, not because of market volatility, but because of regulatory prohibition. Western governments will make it illegal to own Chinese assets. As 2025 began, Ray's Taiwan prediction was looking increasingly accurate. Chinese military exercises around Taiwan had increased in frequency and intensity. Taiwanese elections had produced a pro-independence government that Beijing viewed as illegitimate. American military advisors were quietly expanding their presence in Taipei. More ominously, Ray's intelligence network in Beijing reported that Chinese leaders were discussing what they called the 2027 timeline, a plan to assert control over Taiwan by the Communist Party's centennial anniversary. Ray realized that his China withdrawal hadn't just protected Bridgewater's assets. It had positioned them for the biggest geopolitical crisis since World War II. People ask me if I regret leaving China. Ray reflected in his end-of-year investor letter. The better question is whether I regret staying so long. I spent 40 years believing that economics would triumph over ideology. I was wrong, and that mistake could have cost my investors everything. But Ray's China warning extended beyond investment advice. It was a broader warning about the dangers of wishful thinking in global finance. For decades, Western investors had assumed that economic integration would make war impossible. Countries that traded together couldn't fight each other. Mutual prosperity would triumph over mutual suspicion. China's strategic pivot proved that assumption false. Economic integration hadn't eliminated geopolitical conflict. It had just made the eventual conflict more devastating. We built a global economy based on trust, Ray observed. But trust, like credit, can disappear overnight. And when it does, the consequences are catastrophic. Ray's new investment philosophy reflected this hard-earned wisdom. Instead of betting on global integration, he was positioning for global fragmentation. Instead of assuming cooperation, he was preparing for confrontation. Bridgewater's new strategy focused on three themes: energy independence, technological sovereignty, and financial isolation. Ray was betting that the future belonged to countries that could survive economic warfare, not countries that could win economic cooperation. The era of globalization is ending, Ray concluded. What comes next will test every assumption we've made about markets, governments, and human nature. The investors who adapt first will survive. The investors who cling to the old model will be destroyed. As Ray looked toward 2026 and beyond, he saw a world dividing into competing economic blocs. America and its allies on one side, China and its partners on the other, with everyone else forced to choose sides. In that world, Ray's China withdrawal wouldn't be seen as betrayal. It would be seen as survival. The man who had built his career betting on China's rise was now betting on its isolation. Not because he wanted China to fail, but because he could see the writing on the wall. I love China, Ray reflected. I believed in China. I bet my reputation on China. But loving something doesn't mean ignoring its flaws. And China's flaws have become too dangerous to ignore. Ray Dalio's China warning was complete. The question now was whether other investors would listen before it was too late. Because in Ray's analysis, it was already later than most people thought. The signs Ray had identified were accelerating faster than even his most pessimistic models had predicted. In January 2025, Beijing announced new economic security regulations that effectively banned foreign hedge funds from accessing Chinese government bond markets. Ray watched from his Connecticut office as panic spread through global markets. Investors who had ignored his warnings were now facing immediate losses. Some funds lost 30% of their value overnight. I felt sick watching it happen, Ray confided to his wife. Not because I was right, but because so many people refused to listen. Over the following weeks, Beijing systematically closed foreign access to Chinese markets sector by sector. First technology stocks, then energy companies, finally consumer goods. Each closure trapped more foreign capital. Ray's phone rang constantly during this period. Pension fund managers who had ridiculed his China withdrawal were now begging for advice. Sovereign wealth funds that had doubled down on China were facing political pressure from their governments. Everyone wanted to know the secret to my timing, Ray later recalled. But there was no secret. I just believed the Chinese when they told me what they were planning. In February 2025, China announced its most aggressive military exercises ever around Taiwan. For 6 days, Chinese forces completely surrounded the island. Taiwan's stock market collapsed. Global shipping rates spiked. But Ray had seen this coming too. In his March 2024 memo, he'd warned that China would use military pressure to test Western resolve before any actual invasion. They're not planning to invade Taiwan, Ray explained to Pentagon officials. They're planning to make invasion unnecessary. If they can collapse Taiwan's economy, they won't need to fire a shot. Ray's Taiwan predictions gained credibility when China announced economic sanctions against Taiwanese semiconductor companies in April 2025. TSMC's stock price fell 40% in a single day. Ray had positioned for this exact scenario months earlier. When Taiwanese chip stocks collapsed, American and European alternatives soared, generating massive profits for Bridgewater. But Ray's success brought him no satisfaction. He could see where the escalation was leading. We're witnessing the beginning of Cold War 2.0, Ray warned clients. This time, the economic consequences will dwarf anything we experienced with the Soviet Union. Ray's analysis was based on a fundamental difference. The Soviet Union had been economically isolated from the beginning. China was economically integrated with the entire world. Separating the Chinese and Western economies will be like performing surgery on conjoined twins, Ray explained. Possible, but bloody and traumatic for everyone. By summer 2025, the economic separation was accelerating beyond control. Western companies pulled out of China. Chinese companies were banned from Western markets. Supply chains collapsed. The human cost was staggering. Millions lost jobs on both sides. Consumers faced shortages and price increases as global supply chains disintegrated. Ray watched the crisis with vindication and horror. He'd been right about everything, but being right about a catastrophe didn't make it less catastrophic. When great powers compete, everyone loses, Ray said during a private dinner with other fund managers. There are no winners in economic warfare, only survivors. Ray's survival strategy was radically different from anything he'd practiced before. Instead of betting on globalization, he was betting on deglobalization. Instead of efficiency, resilience. We're not just picking stocks anymore, Ray explained to his team. We're picking sides in the next chapter of human history. In October 2025, China announced the Asian Monetary Union, a regional currency system allowing Asian countries to trade without using dollars. The announcement sent shockwaves through markets. The dollar fell to decade lows. Gold spiked. Bitcoin surged as traders positioned for monetary chaos. This is exactly what I expected, Ray told his team. China can't attack the dollar directly, so they're building an alternative that makes it unnecessary. Brilliant and terrifying. As 2025 ended, Ray found himself vindicated but isolated. His predictions were proven correct, but success came at the cost of 40 years of relationships. Former Beijing colleagues no longer returned calls. Chinese students who once competed to work at Bridgewater now viewed him as a traitor. China banned his books and removed his speeches from the internet. I spent 40 years building bridges between East and West, Ray reflected. Now I'm watching those bridges burn, and I'm the one who warned they would catch fire. Ray's final prediction for 2026 was his most ominous. The economic separation would accelerate until reaching the point of no return, when recombining the global economy would become impossible. We're talking about the permanent division of human civilization into competing economic systems, Ray warned. Once complete, the world my generation built will be gone forever. Ray Dalio's China warning had evolved into something much bigger. It wasn't just about markets or politics. It was about the end of the globalized world and the beginning of something new, uncertain, and dangerous. The man who spent his career betting on global integration was now preparing for global fragmentation. Not because he wanted it, but because he could see it was already happening. And in Ray's analysis, it was already later than anyone imagined.